Thank you so much. We'll get things rolling. Welcome again. My name is Tom Mazurek. I'm a partner in our state and local tax practice here at Tronconi Segura. With me today is an all-star team of our tax and small business professionals. My partner is Andy Toth, who's a partner in our state and local tax practice, and Andy Moon, a partner in our tax practice. We got the best of the Andys with us. And then joining us as well are Mary Shetler, a principal in our small business practice, and Michelle Loretto, a manager in our small business practice. So we've got a lot to cover this morning on this new pass-through entity tax. We're going to take you through some basics about it, how to calculate the pass-through entity taxable income, estimated tax payments, and filing the returns and calculating the credits that are necessary for this. If you do have any questions, please use the question function here and go to webinar, and we will try to answer them as we go along through today's slide deck. The handout, there is a handout in there as well. It's a copy of the slide deck that you're seeing here on screen. Feel free to download it, and obviously, contact your Tronconi Segura tax advisor or one of the folks here on the panel this morning if you have any questions or concerns about whether or not this pass-through entity tax works for you. So I want to get things started right away. I'm going to turn it over to my partner, Andy Toth, who's going to do a brief introduction about what this all is.
Good morning. In April this year, along with the budget, was included a section for pass-through entity tax. And what this is it creates a New York State income tax at the entity level, which is going to create a deduction on your federal income tax return. And that's basically the crux of what we're going to be talking about today and what the true benefit of this is. It's effective January 1 of this year. If a partnership or New York State corporation elects to pay this tax, partners, members, and shareholders of the electing entity who are subject to personal income tax may be eligible for a credit on the New York State income tax return. As you remember a few years back, and this affected a lot of people, with the change in federal income tax laws in 2017, your state income taxes and your property taxes were capped at $10,000. So for a lot of business owners, that had a huge impact because as a business owner with flow-through income, your estimated New York State taxes could be fairly significant. You were no longer allowed to deduct those on your federal return. New York State attempted a few workarounds that were pushed back by the IRS and it just weren't workable. But in 2020, the IRS issued Notice 2020-75, which provides for amounts paid by a partnership or S corporation to a state to satisfy their income tax liability to be deductible by the entities when calculating the federal taxable income. In addition, these payments will not be counted towards the SALT cap at $10,000 cap at the shareholder level. So this is a high-level overview of how this works. This is a flow-through entity. It has $3,000 in income that's going to be picked up on K-1s or reported on individual income tax returns. Assuming those individuals are the 32% rate, the income tax paid on the cumulative individual tax returns would have been $96,000 if they don't make the election. If that entity makes the election for 2021, they're going to pay $20,550 in state taxes at the entity level. It's going to reduce their federal taxable income or the flow-through income to $279,450. That's the money or dollars that are going to flow through on the K-1 to the individuals. And it's going to reduce their individual taxes to $89,424. So it's a savings of $6,500. Obviously, the bigger that number is, the larger the savings are going to be. Imagine if you had another zero after that, fairly significant. In addition to New York, a number of states have already made this workaround. 19 have done it so far, and 4 more are contemplating it. You can find out more about the pass-through entity tax on the New York State website, and also by Googling TSB M21-1. And that was guidance that was issued in August of this year, late August of this year. We've been waiting for that guidance. Even though the law was passed along with the budget, there was very little guidance. We're kind of left on our own to figure it out. But there's significant direction given with this TSB. Answered a lot of questions. There's still more out there, and hopefully there'll be some additional guidance coming.
Thank you, Andy. It looks like the states have finally found a plausible opportunity here to make this workaround work. I know they've been trying since late 2017 when the TCJA passed. It looks like finally now with the IRS guidance, New York has jumped on this, and we'll see what opportunities it creates for pass-through entities.
Yes, I think with that New York State, or with the federal government finally approving of something, you don't have to have that worry that if you go through one of these creative tax schemes, it's all for naught at the end of the day because the IRS wouldn't accept it.
Yeah. No, that's great. Great opportunity here. So, Michelle, I'm going to turn it over to you. Why don't you talk about who can make the election and some of the election process in general for this?
Thanks. So, as Andy explained, this is a benefit to our individuals who have been paying tax on their flow-through entities. So, the people that may make this election on behalf of those businesses is the authorized person, and this typically is going to be the person who signs the return, but it's anybody who can bind them into an agreement. So for our New York State S corporations, it's going to be basically the shareholders or owners. And for the partnerships, it's any member, partner, owner that can bind them into this type of agreement. So just to take one step back to who can make the election from the entity side. So we have, on a high level, really S corporations and partnerships. So any New York State S corporation may make this election, and to add to that, any LLC that has elected S status can also make the election. And then our eligible partnerships, so any partnership that files the New York State partnership return, including LLCs here also, may make this election. So again, this is new for 2021. It's an annual election, so it will be reconsidered every year. If there are changes in your business, talk with your tax advisor to see if it's a benefit this year, even whether you took it last year or not. So it's an annual election. So starting as of January 1st, 2021, this election must be made online. We'll get into that next, how we could do that, and we'll show a few slides. But typically we're going to have calendar year taxpayers if we're talking about our S corporations and partnerships, and they're going to be filing this using their calendar year. If we have any fiscal year taxpayers, probably not as often, but this might be S corporations that have a fiscal year. Just to note, they are making the election for the year in which the fiscal year ends.
So if you have a fiscal year that began before January 1 of this year, you're not eligible.
Right. Not until the year ending in 2021 is when they can start making the consideration of if they should do this or not. So for the election period, so now this is the first year, so we've got different dates. So we're going to make sure to highlight the 2 different dates. So for our tax years beginning on or after January 1st, 2021, the business can opt in now through October 15th, 2021. So we are not far away from the opt-in for 2021. If there's anyone who's considering this, it's definitely a conversation we should be having.
Oh, for sure.
The election's made online. So another important point is you're going to be using your business online service account For those who file sales tax returns, they probably already have it set up, but if by chance the business online service account is not set up and you're definitely thinking of doing this, you should probably start looking into setting up your business online service account so you're ready when it comes time to file. So again, that's for the first year, 2021, we have now through October 15th. Going forward, on a typical year, so after January 1st, 2022, the annual election may be made online after January 1st, but not later than March 15th. So that's an important point. You can't make this decision halfway through the year that you wanted to, in 2022, make your payments for the PTE. Pass-through or tax. You've got to make that decision before March and get your election in.
Yeah, as we'll see, the rules are really stringent here with this tax. There's not a lot of leeway when it comes to making the election, filing the return, amending the return. We'll talk about, in a few slides.
Okay, so for making the election, we have now, hopefully everyone downloads the slides. We keep these for reference. If you're going to go on, here is our link, the link to the New York State website so that you can make this election. Again, this is going to go through your business account, so the owners are going to be making this election. So to opt in, we've got the steps here, but we'll show next. We have some screenshots which might be a little easier to understand, but there really are just a few steps to make this election. So the next one, the screenshot shows the first one. There's really just a little waffle up there for services. So you've logged into your business account and you click on services, and it will take you next to a place where we can pick for the PTET web file. Just to note, you have to pick whether you're filing under corporation tax or partnership tax. But that's for whether you're an S Corp or partnership LLC. And then next step is we really just they've got it all laid out here, pass-through entity tax, annual election. We'll select that, and then we'll be able to start entering a little bit of information. So as I mentioned, they're not asking for a lot here. Just a few things to enter, but it's really just a one-page election that's going to give the person that's responsible for making the election is going to fill out their name, social, who they are, and how they can be contacted. And then down at the bottom, it's really just a yes or no question. Do you agree to opt in? So the owner who's kind of binding them into this agreement, they're going to say, yes, I want to opt in. Now, the one thing we definitely wanted to point out is they have a due date there of March 15, 2022. That is the due date of the pass-through entity tax return for 2021. That is not the due date for opting. That can be a little bit misleading, we thought. So we wanted to make that point there.
Okay. All right, thank you, Michelle. So really, the key here is to make the election, you have to go online through your business account. If you don't have that, it's not that complicated to set up, but it's something you want to get on right away, as we are now under a month to 10/15. So we want to make sure you take care of this in a timely manner, and it gets in. So I'm going to turn it over to Mary Shuttler now. Mary's going to talk a little bit about how you calculate the pass-through entity taxable income.
Right. Thank you, Tom. You now know what it is and who is eligible and how to make the election. The next question is what income should be included? And it includes all items of income, deduction, gain, or loss that flows through to a direct partner, member, or shareholder for New York personal income tax purposes. So basically, it is anyone that is issued a K-1 by the electing entity based on their direct ownership interest. So an electing New York State S Corp calculates its PTE taxable income by aggregating amounts of income, gain, loss, or deduction that flows through for New York tax purposes to direct members or shareholders who are taxable under Article 22, which is really New York State personal income tax. So then the aggregated income and gain is reduced by a loss or deduction without regard to any limitation that would be imposed on the member or shareholder's federal and New York State personal income tax returns. The electing S corporation must then apportion this net amount of taxable income to New York based on the apportionment rule. Excuse me. So if a company is not 100% New York State income, you will need to do additional calculations on this. All right, so our example here is showing a S corporation and that 100% of the income is apportioned to New York. You have two owners, one owns 60% and one owns 40%. There is no need to determine any residency rule status per guidance at this point. And this will be different for partnerships that we'll talk about in next couple slides. So in this example, there is the $300,000 in pass-through entity taxable income by taking the receipts less the deductions. In later slides, we'll show you that what will be due to New York and how the credit is calculated. Partnerships are slightly different, of course, making it a little bit difficult. So for partnerships, before computing its PTE taxable income, an electing partnership is required to classify all direct members or partners that are taxable as resident or non-resident of New York. So there's no part year. This is different from the S Corp, which doesn't require this step. So a member or partnership should be treated as a resident if you are a resident of New York for New York personal income tax purposes for at least half of the year. All other members or partners should be treated as non-residents.
That's different than the typical residency rules, correct? For New York?
Yes.
Yeah.
Yeah.
Okay, so as with S Corp, an electing partnership calculation of its PTE taxable income must include all items of income, gains, losses, or deductions to the extent which flow through and be included in the taxable income of direct members or partners, including guarantee payments, which is another thing that's different than S Corp. So there's another little thing to add on to this. And then a partnership would exclude any income allocated to another partnership, an S Corp, or a C Corp. So again, partnerships do take a little bit more to calculate. So for partnerships to calculate PTE taxable income, an electing partnership must compute both a resident PTE taxable pool and a non-resident PTE taxable pool and add these amounts together. And then also, if a special allocation is present, an electing partnership must take these allocations into account when computing each pool.
It could be something like a built-in gain, or if they have special allocations based on capital contributions. Some partnerships require flow through the service capital contributions or examples. They get pretty complicated, but they're not very you don't feel a lot.
All right. So looking at this next example, we see a partnership is owned by 3 partners, 2 are residents and 1 are non-residents. Once you have the PTE taxable income pool, you must allocate between resident and non-resident and then partners. With this example, keep in mind that partner number 1 gets $500,000 in guaranteed payments. Therefore, we back that out so that we are dealing with $1.5 million that should be allocated between 60% of is $500,000 guaranteed payment, which is where the $1.4 million is calculated, and so on. So partner 2 got, 25% of $5 million, and then partner 3 would get 15%. PTE income, you multiply by the graduated tax rate per this chart, And so as you will see for 2.85%, and then if you're between like 2 million and less than 5, your taxable income is 137,000, 9.65%. The PTE income, 2 million, and it goes up from there. So in this slide, we are assuming there is no payment, and that they both basically have the same tax rate. So for both of them, and I know we have them separated, but it really is the same. It's just the 300,000 times the 6.5% tax rate, and then so that is 20,550. And you can see as you go up to 2 million with the rate, then you are now have a tax of 137,000.
We're having a little difficulty with audio. Try to bear with us, please. We're trying to keep going here. Hopefully the audio keeps getting better. Everything looks okay here. So we're gonna try to continue here. Hopefully it'll fix itself. We're working with our spider phone, so hopefully it fixes, it adjusts. Okay. So thanks for Mary for those comments on that. Andy, you want to talk a little bit about estimated tax payments?
Sure. So first we're going to talk about what happens if you make the election this year for 2021. It's already pretty late in the year. You have to make the election by 10/15. New York State is not going to require the entity to make any estimated tax payments for 2021. The full payment will be due March 15th of 2022. However, if you're a cash basis taxpayer, you need to make the payment by December 31st, or else you're not going to be able to take that deduction on your federal return. And that deduction on the federal return is what creates the benefit of this whole workaround. So that's something to keep in mind. The other thing to keep in mind is even though you make the election, you know this credit is coming, New York State is not going to let you reduce your estimated tax payments for the year. They're requiring you to make the payments in full, and they're basically saying that on the individual level, the PTET credit cannot be used in calculating your estimated tax payments for this year. So you may create a little bit of a cash flow problem, but you know, you'll get a refund next year, and you know, it could be a huge benefit for some of you out there. Now, for years after this year, beginning January 1 of 2022, you're going to calculate the estimate on an online application, and quarterly payments will be due March 15th, June 15th, September 15th, and December 15th. Each quarterly payment should be an amount equal to at least 25% of the required annual payment for the taxable year, and the required annual payment is the lesser of 90% of the tax to be shown on the return of the electing entity, or 100% of the tax shown on the return of the electing entity for the preceding taxable year. So it's the lesser of those. If the electing entity did not make an election to be subject to the tax in the preceding year, the required annual estimated tax payment is 90% of the tax required to be reported on the return for the current taxable year.
Okay, thank you, Andy, for sharing that information about the estimated payments. We got to turn things over now to Andy Moon to talk about calculating filing the PTET annual return.
All right, thanks, Tom. So the filing of the annual return, the due date is March 15th of the following year. So for the 2021 calendar year, the due date is March 15th, 2022. This coincides with the filing due date for your actual S Corp or partnership tax return. So it's nice that these due dates all line up. Again, for fiscal year taxpayers, the due date is still going to be March 15th. It's So it's the due date of whatever the fiscal year ends. So for a fiscal year that ends October 31st, 2022, their due date would be March 15th, 2023, same as all calendar 2022 taxpayers. Extensions. You can file for an extension of the PTE tax return. It is an extension of time to file, not an extension of time to pay. So with that extension, you must make sure all of your PTE tax is paid in full at that point in time. If you're extending the S Corp or partnership return, I would suggest you extend the PTE tax return as well and file all of them at the same time.
Andy, there's no election to extend the opt-in though.
Right, yeah, so you cannot extend the election date. So you must still make the election by March 15th, but you can extend the filing of the PTE tax return out.
So March 15th of 2022, we'd be extending the 2021 return.
Right.
But the election for the 2022 opt-in has to be made by March 15th.
Right, yep, so March 15th, 2022, you must make your election for the 2022 tax year, but you can extend the 2021 PTE tax filing at that point. Another thing to consider, the PTE tax return cannot be amended. And this is why we say if you're extending your S Corp or partnership return, we suggest you extend the PTE tax return, because once it's filed, that's it. There's no going back and changing it. This could create issues. If you do have to amend an S Corp or partnership tax return and it changes your income up or down, your PTE tax paid is what it is at that point. So if you end up amending those returns and your New York State tax goes up, you kind of lost out on some benefit because you didn't pay that in PTE tax. Whereas if your income goes down, you've got too much benefit because you paid more tax than you needed to, and you're going to get that refund, but you took a bigger deduction on the federal return than you really had in tax. The thing to note is those additional refunds may be taxable on the federal tax return in the year that they're received. So it's something to consider. It's going to depend on each individual taxpayer's situation, whether they itemize, what they use for state tax deductions on their itemized deductions, if they take standard deduction, all those things are going to factor in. So it's not a blanket statement going to be taxable, but it's something each individual will have to look at. Calculation of the PTE credits. An electing entity must report its PTE and PTE tax and direct share of its tax it is making available to each direct partner, member, or shareholder in the form of a credit. Total PTE credits an electing entity reports may not exceed the total PTE tax paid by the electing entity. I'm not sure how you could have a credit higher than what you pay, but I don't know if New York's just covering their butt here, or if they figure out something that the rest of us haven't seen yet, but it makes sense to me that your credit can't be larger than the tax you pay. As mentioned previously, the electing entity can only provide credits to its direct partners, members, or shareholders. These credits do not flow through. So if you have a tiered partnership or you have a trust that flows out income to an individual, those credits aren't going to flow through. You can only take the credit as a direct partner. So you can't flow these through in multiple entities. So that's something to be aware of. Depending on your ownership structure, you have to look at that. The electing entity has to provide sufficient information on its return to identify all PTE credit eligible taxpayers and their credit amounts. We don't have guidance on what this is yet, but it most likely will come through on the K-1 that gets issued, or they may have an additional form that gets issued with the PTE return. We'll have to see. Calculation of the PTE credits for an S Corp. Mary kind of went through it. It's pretty straightforward. The tax that paid ends up being the credit, and then you allocate that to each owner based on their ownership percentage. That you have to do it for S Corps. You have to do it this way because everything has to be in proportion to ownership in order to abide by the one class of stock rule. If you're splitting things up different than the ownership percentage, it's an indication of multiple classes of stock, which will blow your S election. You definitely don't want that. Our assumption is this is also why they force you to apportion the S Corp income so that non-resident taxpayers aren't getting a different allocation amount than resident taxpayers, which would indicate two classes of stock and screw up your S election. So This is why everything has to be in proportion to ownership for S corporations.
One quick question, Andy, or guys that came in, does a single member LLC disregarded for tax purposes qualify as a direct partner ownership?
If the single member LLC is an owner of the LLC or S corp, it would qualify as a direct partner because it's disregarded, and so that income or credit would flow through presumably to the individual's tax return if an individual owned that single member LLC. So it might depend on who owns that LLC, but potentially yes.
Thank you.
Calculation of PTE credits for partnerships. Again, this one gets a little bit more complicated. You have resident pools, non-resident pools. You have a couple different allocations that you have to go through, ratio calculations. I'm not going to go through this in too much detail. If you have resident and non-resident owners, you can take a look back at the slides, but I would highly recommend you talk to us or your accountant and work with them on the calculation because it is pretty complicated and you're going to need a lot more information. So just real quick, you have the resident and non-resident pools. You have to allocate income between those two pools. Then you have to figure out a ratio of the income for each pool and then apply the credit to each pool based on the ratio of the ownership and the resident and non-resident income. I'm just going to kind of breeze through a lot of that and go down to claiming the credit, PTE tax credit. So eligible taxpayers that receive a PTE tax credit from an electing entity may claim the credit on Form IT 653 pass-through entity tax credit and attach it to their New York State personal income tax return. This is a new form from New York State, and so this will have to get attached to the individual's tax return in order to claim the credit. A couple notes here: a trust that is a direct partner, member, or shareholder of an electing entity is allowed a PTE credit on the trust tax return, but it is not permitted to distribute any PTE credit it receives to its beneficiaries. So if you do have ownership in your entity through a trust, you need to figure out how that trust is taxed, whether it files a separate return, pays tax at the trust level. The trust could be a disregarded entity, and so it won't matter because that credit is going to be reported on the individual's tax return. And so you really have to figure out how that works and figure out who's going to receive the benefit or if any benefit will be received. A partner, member, or shareholder that is not subject to tax under Article 22, included but not limited to corporate partners, is not eligible for the PTE tax credit. So again, if you have an LLC with corporate partners, they're not going to be eligible for the credit. They're not going to receive any benefit. Neither will any other partnerships that own a partnership. So again, those tiered partnerships are not eligible. So things you have to look at if you have a little bit more complicated ownership structure. Each eligible taxpayer's PTE tax credit is equal to the taxpayer's direct share of PTE tax that was reported by the electing entity on the entity's PTE annual return. Now, as a shareholder, you're going to get information from the entity that lists your PTE tax credit and how much is allocated to you based on your PTE income. If you receive more than one PTE credit, the credits will be aggregated on your personal income tax return. If the amount of the PTE tax credit allowable for any tax year exceeds your tax due for the year, the excess will be treated as an overpayment to be credited or refunded without interest. So again, as I mentioned before, that refund potentially could be taxable on your federal return in the year it's received. So that's something to consider. And then the other thing to consider is the entity is paying tax based on the combined income of the entity. So a partnership that has $5 million in income is going to be paying tax at the 9.65% tax rate. But if that $5 million income gets split out between 100 different partners, their income is probably not going to be high enough at that 9.65% rate. They're going to be paying at the 6.85% rate. So there's a big difference in the tax rate. Most likely they're going to be overpaid. The credit's going to exceed the tax on their personal returns. That's going to be refunded to them. So something to think about, again, could cause cash flow issues if the partnership or S Corp is used to paying only what is due on the returns and not any excess. they could end up paying some excess to their shareholders in this case.
Question, Andy, will this affect AMT tax then?
Yeah, so that's a good question. It's something I was going to bring up later, but we can talk about it now. This is really supposed to be a workaround for the $10,000 SALT limitation, but because of that, it also affects AMT. So if you are a person in AMT tax, you aren't allowed to deduct any state income taxes or state taxes paid, property taxes, for your AMT taxable income. So this will actually help those people that are subject to AMT, because the tax will be deducted at the entity level, which in turn will reduce your overall income and your AMT income, and there will be no add back for state taxes because it's already been deducted at the entity level. To kind of piggyback off of that, another positive of this is that it's going to reduce the income flowing through to you on your federal return before it's what we call an above the line deduction. So it's reducing your AGI, whereas historically state taxes were an itemized deduction, which were considered below the line and deducted after your AGI is determined. So there's a lot of income tax items and credits and phase-ins and phase-outs that are based off of AGI. So if you're in that bubble, reducing your AGI could help you in other ways by giving you a higher child tax credit, higher education credits, higher dependent care credits, all those things. In some of these new tax proposals are based on AGI, so it could help you there as well. So I think regardless of whether or not you benefit from or have a limitation under the $10,000 SALT cap, you could have benefits in other places as well. And even if they do remove the SALT cap, I think this could still be beneficial for a lot of taxpayers. Maybe not as significant, but it could still be beneficial.
A lot of questions about the SALT cap. We'll be seeing in the next couple of months with the new tax and budget proposals in Congress how this is going to affect everyone, coming up very soon.
Mm-hmm. Absolutely. All right. So where was I? Oh, yeah. If eligible taxpayers allowing a PTE credit, they must file an individual personal income tax return to claim the credit. You cannot claim the credit or get a refund unless you file a personal income tax return. So that's going to be important. Addition modification to income. So this is where New York State is not unique at all in historically what they've done. So anybody that has an S corp is used to paying the $6 New York State minimum tax. That minimum tax gets added back to your New York State income because New York doesn't allow a deduction of state taxes against their income. And so what they're requiring here is any PTE tax that is deducted at the federal level, you need to add back to your New York State income. It's really just getting you back to what your normal flow-through income was before this program. And so it's not negative to you, it's actually neutral on the New York State side. The benefit is on the federal side. So on the New York side, it's really just taking you back to what you were before the PTE tax deduction. And so this is something that S Corp shareholders have been doing for a long time. It's going to be a little new for LLCs, but it's nothing out of the ordinary and something that is taken care of on your personal tax return. Resident tax credits. So New York, beginning on or after 1/1/21, resident partners, members, or shareholders will now be allowed to take a resident tax credit against their New York State personal income tax for any PTE taxes imposed by another state, local government, or District of Columbia that is substantially similar to the PTET imposed by New York State. A list of substantially similar taxes that qualify for the resident tax credit will be posted by the tax department. I don't believe they posted anything yet, so we'll have to keep an eye out for when that comes out, and we'll see what they consider substantially similar. Any tax years prior to 1/1/21, they are not allowing a tax credit for these PTE tax that you might have paid to other states. Now, just like for New York, for your New York PTE tax, if you are taking a credit for any PTE taxes paid to that other state, you also have to add back that PTE tax deduction to your New York State tax return. Again, it's just to get you back to what you were before those partnership tax payments were made. So it's the same theory as the New York one.
All right. Well, thank you, Andy. Thanks everybody today. Anyone have any final thoughts I want to mention here? Just a few takeaways we wanted to talk about. Like we said early on, this pass-through entity tax is a workaround to the $10,000 SALT cap that was enacted at the end of 2017 with the Tax Cuts and Jobs Act. You know, we'll see what happens in Congress in the next few months as they're debating a new budget and tax provisions, whether or not this is going to change anything with these pass-through entity taxes that these states, 19 or so states have now been enacting over the course of the last year or so. I think the key thing for everybody here today listening is that you have until October 15th. You have 29 days to elect to opt into this PTET regime for calendar year 2021. If you don't go through that New York business account and opt in, obviously you'll not be able to take advantage of this year. You'll have to wait to make the election next March for 2022. PTEs making the election will have to pay tax on or before March 15th of 2022. There are no estimated payments. I mean, obviously there could be some cash flow issues with that. You're making your individual estimates as well, and then you have to pay this entity tax going along. And if you are a cash basis pass-through entity, you really have to make that payment by 12/31 in order to take the deduction on your federal return. So there are a few things you definitely want to talk to your, TSA tax advisor or your accountant about to see whether or not that this regime makes sense for you.
Just to clarify, there's no estimated tax payments at the entity level. Individuals still need to continue to make their New York State estimated tax payments.
Yeah, and so where that becomes an issue is you're essentially double paying the tax in this first year. And then you're going to be sitting there waiting for New York to issue you a refund on your personal tax return. So we all know how quickly that happened this past year. So it's going to be a little bumpy this first year, and it may change some people's minds on whether or not they want to elect for 2021. I think we did mention for cash basis taxpayers, you have to make the tax payment by December 31st. New York's not even, they're not even going to have an estimated tax or payment form available until December 15th. So you're going to have to really work in the last 2 weeks to get that in. And then additionally, they've announced that the PTE tax filing won't be ready until the end of February. So again, they're going to squeeze you into about 2 weeks to get that return filed. Again, we can file for extensions. I think a lot of people might be extending this year if they're going to be in this program, which in turn we suggest you would extend your S Corp or partnership tax return along the same lines, and possibly your individual return. So this first year, you're just going to have to bear with us. We're kind of just stuck with whatever New York State issues. It sounds like they're going to require everything to be done on that New York State online account, which we might not have access to. So it's going to be figuring it out as we go along, and hopefully New York State has a little more guidance and helps us out here. One other thing I want to mention along the lines of, the question about does it affect AMT, and then, saying that this is really a $10,000 SALT cap workaround. The big question is, well, what if the SALT cap goes away? Just like the things I mentioned before, it still could be beneficial, even if the SALT cap goes away. It helps you out in AMT, reduces your AGI, which could help you in other areas. But also the other part is historically itemized deductions have been limited and phased out based on your income. And again, this deduction won't phase out. So even if the SALT cap goes away, you could still benefit from this by deducting your federal taxes at the entity level rather than as an itemized deduction and then having them phased out because of other limitations. So that's another reason why this could be a beneficial program.
Couple questions came in, Andy, as we were talking here. Ron, really in general, is there any reason not to elect into this?
Yeah, I mean, the only reasons I would say not to elect into it are, you have to do a cost-benefit analysis. There's additional compliance that's required, additional filings, and whether or not the benefit you're going to receive is going to exceed the cost to maybe pay your accountant to do that additional compliance, whether or not certain shareholders get advantage or not advantages from this. And then especially in the first year, what is your cash outlay? Again, the individual has been making and has to continue to make their estimated tax payments throughout 2021, and then the entity pays that tax all over again in March, and the individuals are stuck waiting for those refunds. And then do they have to pay those back to the entity? You know, is the entity just going to be okay with saying, well, you got that extra distribution? So the first year, I think there's more considerations that need to be made on whether or not there's any disadvantages, because there are some things that have to be looked at and worked around. But in general, I think this is a really good program, and there's really not a lot of downside to it. One thing we'll have to keep an eye out for that could be another factor in the future. It's not the case right now, but if you look at Connecticut, who's one of the first states to institute this program, it started out revenue neutral, but now Connecticut says, well, you're getting this big benefit at the federal level. We're going to take a piece of that. So they only give you a credit of like 97% of the tax paid. So whatever tax you pay to them, they're holding on to a small amount of it, because it still is less than the benefit you're receiving at the entity level. So they kind of reduced the overall benefit you're getting and kept a piece for themselves. New York hasn't done that yet. It is a revenue neutral program for New York. But I don't know what you want to put the over-under on how many years before they figure out we're going to take a piece. My number's 3. I think 3 to 5 years they're going to figure that out.
I would say New York's going to want their vig on this.
Oh,
they're going to want their little piece of it. You know, as they get into online gaming, this is like their we're going to take a little piece of this too now. So
yeah, so that's something to keep an eye on. It's not a big deal because this is an annual election. And so, you know, if they do that, you can say, well, I'm not going to elect into the program anymore. That's fine. But along those lines, you just want to, you know, the other downfall is once this election is made, it is irrevocable for that year. So if you make that election by March 15th, and then May, June, July, August hits, and your income's way down and you have a loss, maybe it doesn't make sense to be in the program. Too bad. You made the election to be in. You got to stay in the program. So you might not receive any benefit now, but you still have to do all that additional compliance.
Yeah, and we'll be reaching out to all our clients here internally. Our tax folks, know all about this now, and we're going to be reaching out over the next couple of weeks to our clients who are pass-through entities, help them make this decision about this election and whether or not this is something that's beneficial. Just a couple other quick questions, guys, and you can probably jump off here. Is there any word on the refund created by the credit, and will it be taxable on the federal return?
I mean, there hasn't been any specific guidance on it, but I think you have to treat it as any other state income tax refund, and it's going to be dependent on that individual situation on whether or not it's taxable. You're going to have to follow the rules that are out right now. The answer is potentially yes, but without knowing that individual's tax situation, we can't say for sure.
Okay. One other question, if anyone else has questions, please get them in now. One other question, how will QBI be affected?
So QBI will be negatively affected because it is reducing your QBI income, which, again, that has to be factored into your cost benefit analysis. What are your savings actually going to be from this program? So it's going to make your savings a little bit less, but again, that has to be done in the you have to figure that out for your specific situation. For a lot of professional services firms like attorneys, they weren't getting probably any benefit from QBI anyway, so it could be beneficial for them because they're not going to be subject to it. But.
All right. Well, I think we've answered all the questions that were here. Again, if you have specific questions, please reach out to your tax advisor here at Tronconi Segura & Associates. If you are not a client, you can reach out to us through our website. There's a contact us box feature. Someone will get back to you within 24 hours, or definitely feel free to email one of the presenters. Their email addresses are on the screen right now and in the slides. This time, I want to thank the Andes and Mary and Michelle for being with us this morning and taking the time to prepare the presentation and be here to answer these questions. It's a unique opportunity here with New York starting now in 2021. We'll see how this works out. And like I said, if you have any questions, definitely feel free to reach out. We want to thank you for joining us this morning. and look forward to having you on future tax and accounting and COVID webinars that Tronconi Segura and Associates does and puts on a regular basis. Thank you and have a nice day.